So the other day, I opened up my Robinhood app and I saw 98 shares of SCHD, which I had no idea I was so close to the 100 share mark. That's the nice thing about dollar cost averaging in the positions you love. Eventually, after a while, you just sort of suddenly hit these milestones. And I decided, you know what, I'm gonna treat myself. Treat yourself. So I bought a little more, enough to get me over the 100 share milestone, and now let me show you how much those shares just paid me. $82.75. That's my biggest dividend from a single position I have ever received. And the best part is that I did no extra work for that money. It automatically got reinvested back into SCHD, so I get even more shares for free, and then those shares combined with what I already had will continue to pay more dividends in the future, and the cycle continues on and on. Now I know some of you are probably wondering, why am I so excited for such a small amount of money? It's because this is just the beginning. When you first start dividend investing, you're typically not earning a ton in dividends, but I'm sure you'll agree that every big thing we've ever heard of at one point started small. In my case, my Robinhood account started from $0. I went to school, have a full-time job currently, pay my bills, and with whatever is left over, I get to decide what to do with it, which I think most of us are in a similar position or will be in a similar position soon. Every time I invest in SCHD, it's like I'm securing a little bit of income for the future that I don't have to work for, which is important to me because in the future, I might not be able to work the way I am able to now, and I want to be prepared for that. So if most of us are starting at a $0 portfolio and investing what we can when we can, our first dividends are probably really only worth a few pennies or a few dollars here and there. And that's not really very exciting, but eventually with the right assets, market conditions, dollar cost averaging, a long enough time horizon, and a sprinkle of compound interest, the idea, remember this is still investing, there is risk of losing money here, is that the portfolio balance and number of shares owned should go up, but this would also mean the dividends go from being able to buy a few items from the dollar menu to a tank of gas every now and then, to being able to pay off the internet or cell phone bill, then to paying all the utility bills, then the mortgage payment, then living entirely off the dividends. At least that's the idea. So for a dividend growth investor or someone who is investing with the intent of growing a dividend payout year over year, one of your core holdings in your portfolio might be SCHD. And there's good reasons for that. It has a growing dividend, a consistent dividend, a relatively low expense ratio, and has grown in value over time. So for me, this all combines into an investment I can hold through the ups and downs of the market and life. I can confidently say I have never lost any sleep over my SCHD position, which is super important for me and maybe you as well, because when I think of retirement or a situation where I'm using my dividends to supplement my income, I want that part of my life to be as stress and worry-free as possible. One day, I'll hopefully be a full-time grandpa and my job will be to make the best pancakes ever. And that's really what it's all about, to be able to protect against some of life's unknowns and take care of financial realities, to live life on our terms and, of course, make the best pancakes. This can happen with the right assets. So let's review what SCHD is all about, who this ETF is ideally for, and do some fun math so we can estimate how much we would need to invest to potentially live off this one position from just the passive dividend income alone. Hey, before we deep dive into SCHD, if you're finding value in this video, be sure to click the like button. This lets YouTube and myself know to give you more content like this in the future. So SCHD's government name is the Schwab US Dividend Equity ETF, and its objective is to track as closely as possible, before fees and expenses, the total returns of the Dow Jones US Dividend 100 Index, and it has a current dividend yield of 3.64%. Its expense ratio is 0.06%, which I know is more expensive than something like VOO at 0.03%, but the secret sauce for SCHD is the growing dividend, and we could see that since inception, it has just continued to march higher and higher. In addition, it's important to note that SCHD continued to pay out a dividend from the end of 2019 all the way through 2020 and 2021 as well. I'm sure we all remember what was going on during that time period, so it's nice to know that during the uncertainty of the markets, SCHD was able to hold strong historically. From the fact sheet, we can see that since inception, it's held its own against the index, and the fund seems to have found success with its overall strategy. In order to get to the finer details of the strategy, we need to jump a little bit deeper into the prospectus, and here we can find a section called the Principal Investment Strategies of SCHD. Before we jump in, this YouTube channel has the ability to draw in some really smart, experienced people, and I am a one-man operation. If I get something wrong, leave something out, or you want to add further context to the video, leave a comment in the comment section. I want to know about it. To pursue its goal, the fund generally invests in stocks that are included in the Dow Jones US Dividend 100 Index, which is designed to measure the performance of high dividend yielding stocks issued by US companies that have a record of consistently paying dividends, selected for fundamental strength relative to their peers based on financial ratios. The 100 component index is a subset of the Dow Jones US Broad Market Index, index, excluding real estate investment trusts or REITs. It also excludes master limited partnerships, preferred stocks, and convertibles. It is modified market capitalization weighted. All index eligible stocks must have sustained at least 10 consecutive years of dividend payments, have a minimum float adjustment market capitalization of 500 million USD, and meet liquidity criteria. And by the way, liquidity is so important because when you're moving money into a position, you want to make sure you can move it out as well, or risk being stuck in a bad trade, which is a huge deal when you're moving millions of dollars worth at any given moment. So be sure you remember this when you want to jump into a low market cap cryptocurrency as well. The index components are then selected by evaluating the highest dividend yielding stocks based on 4 fundamentals based characteristics: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Stocks in the index are weighted based on a modified market capitalization approach. No single stock can represent more than 4.0% of the index, and no single sector, as defined by the index provider, can represent more than 25% of the index as measured at the time of index construction, reconstitution, and rebalance. The index composition is reviewed annually and rebalanced quarterly, which means new stocks enter and leave yearly. The ratios are adjusted every quarter. It is the fund's policy that under normal circumstances, it will invest at least 90% of its net assets, including, for this purpose, any borrowings for investment purposes in these stocks. The fund will notify its shareholders at least 60 days before changing this policy. The fund generally will seek to replicate the performance of the index by giving the same weight to a given stocks as the index does. However, when the investment advisor believes it is appropriate to do so, such as to avoid purchasing odd lots, i.e. purchasing less than the usual number of shares traded for a security, for tax considerations, or to address liquidity considerations with respect to a stock, the investment advisor may cause the fund's weighting of a stock to be more or less than the index's weighting of the stock. The fund may sell securities that are represented in the index in anticipation of the removal of the index, or buy securities that are not yet represented in the index in anticipation of their addition to the index. So this is basically saying the fund managers have a little flexibility with the funds should they need the wiggle room. Under normal circumstances, the fund may invest up to 10% of its net assets in securities not included in the index. The principal types of these investments include those that the investment advisor believes will help the fund track the index, such as investments in securities that are not represented in the index, but the investment advisor anticipates will be added, or is necessary to reflect various corporate actions like mergers or spin-offs. Other investment companies and derivatives, principally futures contracts, are also included. The fund may use futures contracts and other derivatives primarily to seek returns on the fund's otherwise uninvested cash assets to help better track the index. The fund may also invest in cash and cash equivalents, including money market funds, and may lend its securities to minimize the difference in performance that naturally exists between an index fund and its corresponding index. The fund will concentrate its investments, i.e. hold more than 25% of its total assets in a particular industry group or of industries or sector to approximately the same extent that the index is concentrated. So investment advisors seek to achieve over time a correlation between the fund's performance and that of the index before fees and expenses of 95% or better. However, there can be no guarantee that the fund will achieve a degree of high correlation with the index. A number of factors may affect the fund's ability to achieve high correlation with the index, including transaction costs, asset valuations, corporate actions such as mergers and spin-offs, timing variances, and differences between the fund's portfolio and the index resulting from legal restrictions such as diversification requirements that apply to the fund but not to the index. And just for the record, I do realize, yeah, that was a lot, but we do actually need to make sure we know all that stuff. So feel free to watch that as many times as you need to. I had to read it quite a few times. So if all that was up your alley, you're probably a long-term investor with a time horizon measured in decades as opposed to weeks or months. You're interested in steady returns overall, a growing and consistent dividend, and having all this being derived from larger market cap US stocks. You might also appreciate some diversity in the holdings to avoid concentration risks. That sounds like an SCHD investor to me. And if you're still here with me after that deep dive into SCHD strategy, you'll probably enjoy money, finance, crypto, dividends, all the above and more. We talk about that on this channel, so consider clicking the subscribe button. So for fun, if you wanted to make $60,000 a year from SCHD at a dividend yield of 3.64%, you would need a total investment of about $1,650,000. Now, I don't expect everyone to have over $1 million on hand, but let's say hypothetically we decided to invest a lump sum and let it sit for a while, say 35 years. At an average yearly return of 11%, a yearly dividend of 3% with no growth hypothetically, assuming we reinvested all the dividends and this grows over time, taking into consideration a 15% tax rate, we'd need $34,500 initially invested to get to $1.65 million, according to this calculator. And if we don't have a lump sum to invest and wait, we can always dollar cost average. Using the same parameters as the first calculation, we would need to invest $4,350 a year or $362.50 a month. So great to keep in mind, but of course this is just for fun, makes a lot of assumptions as well. The key takeaways for me are really to invest consistently for the long term in growing assets and let compound interest do its thing. Now with SCHD or any investment, there are downsides, and we need to know about those as well. We want to be as fully informed about our investments as possible, so that's why I decided to ask ChatGPT to tell me the issues with SCHD, but also help me fix the issues as well. So if you want the other side of the story, which I think is incredibly important for anyone who owns SCHD or is considering it, feel free to check out that video. It should be up in a few days, so if you don't see it yet, be sure you're subscribed to the channel and have notifications turned on so you know when it pops up. Thanks for watching, and I'll see you over there.